Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Decoding the Dividend Payout Ratio. Unlock financial growth. Ever wondered how companies decide how much money to share with their shareholders? That's where the dividend payout ratio comes in. It measures the percentage of earnings a company pays out as dividends. Understanding this ratio can help you gauge a company's financial health and its commitment to returning value to shareholders. A high payout ratio might indicate steady income and confidence, but it could also mean less reinvestment in growth. Conversely, a low ratio could suggest the company is focused on expanding its business, which might lead to higher future profits. By understanding the dividend payout ratio, you'll be better equipped to make informed investment decisions. Dive in to explore how this critical metric impacts your portfolio's potential. Understanding dividend payout ratio. Dividend payout ratio is a vital metric to evaluate a company's financial health and dividend distribution strategy. By understanding how to calculate and interpret this ratio, investors can gain insights into a company's dividend sustainability and growth potential. Formula and calculation. The formula for calculating the dividend payout ratio is straightforward. It is the dividends per share divided by earnings per share. Dividends per share represent the total dividends paid out to shareholders per outstanding share, while earnings per share indicate the company's net income earned per outstanding share. For example, dividend payout ratio equals dividends per share, earnings per share. Interpreting the ratio. Interpreting the dividend payout ratio involves analyzing different ranges to assess a company's financial position and future growth prospects. A high dividend payout ratio may suggest that a company is distributing a significant portion of its earnings to shareholders, which could limit reinvestment in the business for future growth opportunities. On the other hand, a low ratio may indicate that the company retains more earnings for potential expansion and dividend increases in the future. Understanding the nuances of the dividend payout ratio can help investors make informed decisions regarding dividend income and long-term investment strategies. By considering this ratio alongside other financial indicators, investors can gauge the financial stability and growth potential of a company. Benefits of high and low dividend payout ratios. Investors often weigh the benefits of high and low dividend payout ratios when making decisions about where to allocate their funds. Understanding the advantages and disadvantages of each can help you make informed investment choices tailored to your financial goals. High dividend payout ratios. High dividend payout ratios can be appealing to investors seeking regular income from their investments. Companies with high dividend payout ratios typically distribute a significant portion of their earnings to shareholders in the form of dividends. This steady income stream can be attractive for investors looking to supplement their cash flow or build a portfolio geared towards income generation. However, high dividend payout ratios come with their share of risks. Companies that pay out a large percentage of their earnings as dividends may have limited funds available for reinvestment in their business. This could potentially hinder the company's growth prospects or ability to weather economic downturns. Additionally, a high dividend payout ratio may signal that a company is struggling to find profitable investment opportunities or is unable to sustain its dividend payments in the long run. Low dividend payout ratios. On the other hand, companies with low dividend payout ratios offer a different value proposition to investors. A low dividend payout ratio indicates that the company retains a larger portion of its earnings rather than distributing them as dividends. This retained earnings can be reinvested back into the business for expansion, research and development, debt repayment, or other growth initiatives. Investors who prefer companies with low dividend payout ratios often look for capital appreciation rather than immediate income. These companies have the potential for higher growth rates and may reinvest profits to fund innovation and strategic initiatives. By retaining earnings, companies can strengthen their financial position, pursue new opportunities, and increase shareholder value over the long term. Both high and low dividend payout ratios offer distinct advantages and drawbacks for investors to consider. Understanding the implications of these ratios can help individuals tailor their investment strategies to align with their financial objectives and risk tolerance. By weighing the benefits and risks associated with different payout ratios, investors can make well-informed decisions that support their long-term financial well-being. Impact on investors. When it comes to considering the impact of dividend payout ratios on investors, it's crucial to delve into the various investment strategies that can be adopted based on this ratio. Understanding how dividend payout ratios influence investment decisions can help investors make informed choices and align their strategies with their financial goals. Investment strategies. Investors evaluating companies with varying dividend payout ratios can employ different investment strategies to optimize their portfolios. High dividend payout ratio companies. For investors seeking regular income streams, companies with high dividend payout ratios can be attractive. These firms distribute a significant portion of their profits as dividends, providing investors with consistent returns. However, it's essential to assess the sustainability of high dividend payments and the potential for future growth. Low dividend payout ratio companies. On the other hand, companies with low dividend payout ratios may reinvest a larger portion of their profits back into the business for expansion or innovation. Investors looking for capital appreciation may favor these companies, as retained earnings can fuel growth and potentially lead to higher stock prices in the future. Moderate dividend payout ratio companies. Companies maintaining a moderate dividend payout ratio strike a balance between rewarding investors with dividends and reinvesting in the business. Investors seeking a mix of income and growth potential may find these companies appealing. By receiving dividends while benefiting from potential capital appreciation, investors can diversify their sources of returns. Dividend growth investing. Another strategy involves focusing on companies with a history of increasing dividends over time. These firms demonstrate financial stability and a commitment to rewarding shareholders. By investing in companies with a strong dividend growth track record, investors can potentially benefit from rising income streams and enhanced total returns. Choosing the right investment strategy based on dividend payout ratios requires careful analysis of individual companies, market conditions, and personal financial objectives. By aligning investment decisions with an understanding of how dividend payout ratios impact investor returns, individuals can build diversified portfolios tailored to their risk tolerance and long-term goals. The dividend payout ratio is a critical financial metric that investors use to assess a company's dividend sustainability and growth potential. This ratio measures the percentage of earnings that a company pays out to shareholders in the form of dividends. Understanding the dividend payout ratio can provide valuable insights into a company's financial health, management's capital allocation decisions, and its ability to generate sustainable long-term returns for investors. The dividend payout ratio is calculated by dividing the total dividends paid by the company by its net income. For example, if a company pays out $2 per share in dividends and earns $4 per share in net income, its dividend payout ratio would be 50%, $2 divided by $4. A lower payout ratio indicates that the company retains more earnings to reinvest in its business or pursue growth opportunities, while a higher payout ratio suggests that the company distributes a larger portion of its earnings to shareholders. A company's dividend payout ratio can vary depending on various factors, including its industry, growth prospects, and financial objectives. Mature, established companies with stable cash flows often have higher payout ratios, as they prioritize returning value to shareholders through dividends. On the other hand, growth-oriented companies may have lower payout ratios as they reinvest more of their earnings back into the business to fund expansion initiatives. Investors typically look for a balance between dividend payouts and retained earnings when assessing a company's dividend payout ratio. A payout ratio that is too high may indicate that the company is over-distributing its earnings, leaving little room for future growth or capital investment. Conversely, a payout ratio that is too low may suggest that the company is not returning enough value to shareholders or lacks confidence in its future prospects. Moreover, the trend and consistency of a company's dividend payout ratio are essential considerations for investors. A stable or gradually increasing payout ratio over time can signal financial stability and management's commitment to returning value to shareholders. Conversely, a fluctuating or declining payout ratio may raise concerns about the company's ability to sustain its dividend payments or generate consistent earnings growth. It's essential for investors to compare a company's dividend payout ratio with industry benchmarks and peer group averages to evaluate its performance relative to its peers. A company with a significantly higher or lower payout ratio than its industry peers may warrant further investigation to understand the underlying reasons for the disparity. Additionally, investors should consider qualitative factors such as the company's competitive position, industry dynamics, and growth prospects when interpreting the dividend payout ratio. In conclusion, the dividend payout ratio is a key financial metric that investors use to evaluate a company's dividend policy and financial health. By analyzing this ratio, investors can gain valuable insights into how much of a company's earnings are being returned to shareholders in the form of dividends and assess its ability to sustain and grow its dividend payments over time. When used in conjunction with other fundamental and qualitative factors, The dividend payout ratio can help investors make informed decisions about their investment portfolios and unlock long-term financial growth. Furthermore, a low dividend payout ratio does not necessarily imply financial strength. It could indicate that the company is retaining earnings for growth opportunities or to strengthen its balance sheet. Conversely, a high payout ratio may not always be a cause for concern, especially for mature companies with stable cash flows and predictable earnings. Investors should consider the context of the company's industry, growth prospects, and overall financial strategy when interpreting the dividend payout ratio. By analyzing this metric alongside other fundamental indicators, investors can gain a comprehensive understanding of a company's dividend policy and its potential for long-term growth. Stay tuned for part 2 and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.